All right, all eyes have certainly been on Europe lately, but those eyes may want to turn their glance eastward or westward from here because there are some worrying signs coming from China, right? Forget Europe. Let's talk about China for a moment. Look at this. The Shanghai Composite Index has been slammed. In fact, it is nearing a two-year low, and it is down 57% from its highs back in late 2007. And even with all the optimism about China's fast-growing economy, our markets, slow growth America, have actually done better. There's the Shanghai comp. Let's overlay that with the S&P 500. Look at that. Yeah, we are down from our highs as well. But as you can see, the S&P 500 is down much less than the Shanghai comp. In fact, we're down only, I say only lightly, but only by 17%. So even with our GDP growth relatively stagnant and theirs booming, that has not translated into gains for stock investors there. They've done about 3 times worse than us since the highs right before the financial crisis. Now, to be fair, guys, 2 quick points. Number one, the Shanghai market is much smaller and less liquid than ours. The Hong Kong Hang Seng has performed slightly less bad than its domestic counterpart and very difficult for foreigners to buy stocks on the Shanghai Composite. But still, with all that in mind, are investors telling us that China may be in for some tougher economic times ahead, perhaps an economic hard landing? Our next guest just returned from a trip there. Let us bring in Andy Tananbaum. He is executive chairman of Capital Business Credit. They lend money to small and mid-sized Chinese exporters as well as U.S.-based importers of goods. They're on both sides. They have their ear to the ground. Andy, welcome to Street Signs. Is China slowing down?
Yes, I would say it is. The last information that was publicized is that the manufacturing sector is slowing down.
To what extent, though? I mean, like, we're coming off a very high base here. To what extent are they going to slow down? And considering the very impressive arsenal that all the Chinese authorities have at their disposal to try and prevent a slowdown, do you think they're going to be successful in stopping that?
Well, I think what they did in last week while I was there about reducing the reserve requirements was an effort to slow down that slowdown.
Well, unfortunately, the market it rallied there a little bit on that news, and it's given that up and more. What's a better indicator, right? I'm sure you track Chinese stocks at least somewhat, right? You want to know where they're going.
And you work with a lot of Chinese SMEs as well.
I would say
telling you at the grassroots level.
Well, I would say I don't follow the stock market as much as I follow the trade flows between China and the United States, China and Europe.
The reason I bring this up, Andy, is that a lot of people have called into question the validity of a lot of Chinese data, right? They just don't necessarily trust the official government data as much as they should. They look at things like you're looking at, right? How much of a difference do you see between the government data and the trade flows or whatever it is you watch of actual business there?
Well, actually, in terms of trade flows, I think they're pretty accurate because the information that you can collect on trade flows are collected every day by a lot of non-governmental agencies, including our all the documents and inventory that flows through our ports.
What are you hearing anecdotally as well with some of these Chinese importers and exporters that you speak to? I'm really interested in whether or not they're being impacted on the margins, for example, by the rising cost of labor, by the ongoing gradual appreciation of the Chinese yuan. I mean, gradually China is becoming a lot less competitive than it used to be.
Well, I would say 2 things. Number one, those things are very true. The profit margins for the Chinese exporters are down. But the biggest stress that the small to medium-sized enterprise has is that they've been extending terms of trade to their U.S. and European customers, and now they need to have that cash flow accelerated, which is why we're in looking at that market.
Are they talking to you about the stress coming out of Europe? Are they seeing a significant slowdown in terms of trade flow from the European zone?
Well, approximately 60% of the combined U.S. and European exports go to Europe. And number one, that's slowing down. They're very concerned about long term. They're also concerned about the European banks because they are the engine for a lot of trade finance. And you know what that means is right now they're reducing their exposures and they're what we would call trying to reduce their exposure to assets.
Andy Tananbaum, Capital Business Credit. Hey, we appreciate it. Thanks for coming on the show. We love to get people who actually do the work. You're on the ground there.
Yeah.
You know it. Thank you very much. Good to meet you. We'll see you again.
My pleasure.